Welcome back to the deep dive. Today, we're digging into a sector that's, well, really catching attention lately.
hmm
We're seeing reports like this one from Dolat Capital talking about bumper earnings, even with, global markets being all over the place.
That's right. We're looking at oil and gas, specifically the Q1 FY26 earnings preview. And the numbers, they are pretty striking when you first see them.
Absolutely. So, our mission today really is to unpack why, what's behind this performance. We'll use this Dolat Capital report, look at some key companies, and try to pull out the nuggets that matter for you to understand this crucial industry.
And that big picture you mentioned, it really does set the scene. The overall sector performance, based on the companies in this report anyway, was quite dramatic in Q1 FY26.
How dramatic are we talking?
Well, think about core operational profit, EBITDA. It surged 33% compared to last year and 17% just from the previous quarter. We're talking over 1 trillion rupees.
Wow, over a trillion. Okay.
Yeah. And then the bottom line, profit after tax, or PT, that jumped even more, up 53% year over year, 19% quarter over quarter, around Rs 540 billion. These aren't just small increases.
No, that's a serious turnaround. So is this just the market, or are there specific drivers behind such a big shift? What's the main lever here?
It seems to be a real confluence of factors.
Hmm?
One major driver the report points to is what they call supernormal gross marketing margins, GMM, especially on petrol and diesel.
Supernormal margins, so basically making more profit selling fuel.
Exactly. Maybe input costs fell faster than pump prices, or demand stayed strong. The big question for anyone watching, of course, is how long can that last?
Right, sustainability. Okay, so better margins on selling fuel. What else?
Second, there was a big rebound in the Singapore GRM. That's the gross refining margin benchmark, basically how much profit a refinery makes turning crude into products.
Okay.
It bounced back from a 15-quarter low, actually. US $3.01 per barrel, up to US $5.06.
Significant jump.
Definitely. And then on the cost side, LPG under recovery. That dropped by 37%, which, sparks some hope maybe for government compensation down the line.
Ah, the policy angle.
Right. And finally, cheaper gas inputs. Lower crude-linked LNG costs, helped by falling Henry Hub prices in the U.S., and the rupee actually appreciated slightly, about 1% against the dollar, quarter on quarter. Cheaper inputs, better profits. Simple as that sometimes.
So better refining margins, much better marketing margins, cheaper gas inputs. It sounds like a trifecta.
It really does seem like a strong set of tailwinds came together.
But you mentioned the report also adds some nuance. It wasn't like a universal party across the board, was it?
No, exactly. That's crucial. While the headlines look great, it's not uniform. For example, India's overall LNG imports were actually down 4% year over year in Q1.
Oh, interesting.
Yeah, and you see specific players like Petronet LNG losing market share, about 7% compared to last year going to other terminals.
Okay.
And GL had issues with transmission volumes because power and fertilizer plants use less gas.
So even in a boom, there are still individual struggles and competition. Good point. Okay, let's zoom in then. The oil marketing companies, the OMCs, this is where the bumper earnings really hit home, right?
Yeah.
HPCL, BPCL, IOCL, what drove their huge boosts?
Yeah, they were definitely front and center. Primarily, it was those supernormal auto fuel margins we talked about, averaging Rs 13 per liter profit.
I think up from what?
Up from about Rs 8 per liter the previous quarter. So a huge jump in profitability per liter sold.
Okay, that's massive.
It is. And then add that 37% drop in LPG under recovery. That helped them directly because LPG prices fell, and there was that Rs 50 per cylinder price cut back in April 2025.
And the government part is interesting, too. The report mentions the excise duty hike, Rs2 a liter on petrol and diesel, aimed at covering that LPG under recovery. But does relying on policy like that add a different kind of risk?
That is a very good question. It's definitely a double-edged sword, as you say. If the government does provide that compensation fully, the report estimates it could boost equity value, maybe Rs7 a share for HPCL, Rs4 for BPCL, Rs2 for IOCL, mainly by cutting their debt.
Wow, so a direct link between policy and share value there.
Clearly. But yes, it does tie their results pretty closely to ongoing government decisions and support. Creates uncertainty, perhaps.
Makes sense.
Yeah.
What about the refining side for the OMCs? How did that play out?
That was another big positive. The Singapore benchmark, GRM, it jumped 80% quarter over quarter. Huge increase.
80%. Why such a big leap?
Driven by stronger cracks. That's the margin on specific products. Diesel, petrol, LPG, jet fuel. The cracks for those were stronger. Plus, the restoration of Russian crude supply probably gave them access to cheaper crude oil.
Okay, so multiple strong currents pushing them forward, and the individual results reflect that, HPCL especially.
Oh, absolutely. HPCL was kind of the star performer based on these numbers. EBITDA up 342% year-on-year, 60% quarter-on-quarter. And the PAT, the profit after tax, up over 1,500% year-on-year.
1,500%. That's
It
staggering.
really is. BPCL also very strong. EBITDA up 92% year-on-year, 40% quarter-on-quarter. IUCL too. Significant growth, 99% year-on-year, 27% quarter-on-quarter on EBITDA. The OMCs clearly caught that wave.
Okay, moving down the chain a bit. City Gas Distribution, the CGDs. How did they handle the quarter balancing gas costs and sales volumes?
Generally pretty well.
Yeah.
The expectation is for solid growth, maybe 13% on EBITDA, 11% on PAT, quarter over quarter.
And what's driving that for them?
Mainly that sharp drop in their input gas costs.
Mm.
Plus, they managed some partial CNG price hikes in certain areas, so managing costs effectively was key for them.
And within that group, was there a standout, a biggest beneficiary?
MAHGL looks like a key winner, according to the report, because about 35% of its gas supply is linked to those Henry Hub prices.
Ah, the U.S. benchmark that fell sharply.
Exactly. It dropped about 25%. So calculations suggest MAHGL could see its gas cost fall by maybe RS2 per standard cubic meter. That leads to a projected unit EBITDA of RS 10.5 per C-meter, which is quite strong.
Nice margin. How about their volumes?
Volumes look steady too. CNG registrations holding up, around 8,000 a month, slightly up year-on-year. And CNG adoption seems to be rising in their areas. So expected CNG volume growth is around 8% year-on-year, 2% quarter-on-quarter. Lower costs, steady volume. That's a good combo.
Definitely a strong position. What about IGL? They made headlines raising prices in Delhi, right? What's the story there?
Yeah, IGL raised CNG prices, which should boost their overall realization maybe by RS 0.8 per C-meter. But on the cost side, they're also expecting a decent drop, maybe RS 1.5 per C-meter.
Why the cost drop for them?
Multiple reasons, actually. Better gas allocation, the general fall in crude prices, the Henry Hub decline again, lower costs for certain types of domestic gas, and falling spot LNG prices too. So lots of cost relief.
Okay, and volumes?
Volumes, maybe a bit more modest. Expected up 3% quarter-on-quarter for CNG, maybe impacted slightly by the holiday season, but their unit EBITDA is still expected around RS 6.5 per C-meter. So they manage costs well and use pricing power.
Got it. And then GUJGA. Facing some volume issues, I think you mentioned, but margins holding up.
That's the picture for GUJGA. Total sales volume expected down about 3% quarter-over-quarter. The main drag seems to be their industrial P&G business in Morbi.
Industrial demand softening there.
Looks like it. That specific segment volume is expected down 11% quarter-over-quarter and a huge 48% year-over-year. The report notes it's the lowest volume for that segment in, 10 quarters. So a definite pressure point.
But margins are okay despite that.
Yes, because despite the volume risk, GJGA benefits a lot from the general fall in crude prices, about 10% quarter-over-quarter. That's estimated to cut their overall gas cost by around RS 2.5 per C-meter. So they're still looking to solid unit EBITDA of RS 6.8 per C-meter. Shows how cost management can buffer volume hits.
Really interesting how varied the stories are even within that segment.
Okay, let's pivot to the big diversified players and the pipeline companies. Seems like more of a mixed bag here. Reliance, for instance, seems strong across the board.
Absolutely. Reliance's growth looks robust, driven by, multiple engines. Their core oil to chemicals, O2C, business performed well. Strong refining margins, better petrochemical margins, plus cheaper ethane feedstock helped there.
And they also benefited from those high fuel marketing margins.
Yes, they have their retail fuel joint venture.
Yeah.
And the report notes they processed or imported quite a bit of Russian crude, maybe 60% in April, May, which likely meant cheaper input costs contributing to those supernormal margins.
Right, so the energy side is strong, but it's not just energy for them, is it?
Not at all. That diversification is key. Retail and telecom both showing healthy double-digit growth in revenue and EBITDA year over year. Telecom added, 8 million new subscribers? And their ARPU, the average revenue per user, ticked up again, 2.1% quarter over quarter to over RS 210. So a very balanced growth picture for them. Okay, now GAIL. You mentioned transmission challenges. What's happening there?
Yeah, that's a key point for GAIL. Their transmission volume, moving gas through pipelines, is expected around 124 million standard cubic meters per day. That's actually down quite sharply year over year, nearly 6%.
Why the drop?
Seems to be lower demand from big users' power plants, fertilizer plants, just less gas being consumed by those sectors. And some specific pipeline volumes haven't come back as expected.
Any other pressures on GAIL?
Yeah, their petrochemical plant wasn't running full tilt, maybe 75% utilization due to some maintenance, and margins there were weaker. LPG profitability also took a bit of a sequential hit.
So some definite headwinds. Anything positive on the horizon?
There is. Their gas trading volumes are expected to improve. They started getting new LNG supplies from Qatar, about 0.75 million tons per annum, starting in April 2025. So that should help future earnings.
Okay, some relief there. And Petronet LNG, PLNG. You mentioned market share loss earlier.
That's right. They seem to be feeling the competitive pressure. Market share down 7% compared to last year, losing out to other terminals.
What's causing that shift?
A big factor seems to be GAIL's Dale breakwater facility getting commissioned. It ran at nearly 50% capacity in June, and that's directly eating into PLNG's volumes. Their expected regas volume is about 224 TBTU, down 15% year over year.
How are their terminals running?
Dahej is still high, 92% utilization, but Kochi is much lower, only 25%. And importantly, their earnings are expected to be hit by a provision, about Rs 1.3 billion for use or pay contracts, basically paying for capacity they couldn't sell.
Ouch. Okay, just quickly before we wrap up, any brief notes on GSPL or ONGC?
Sure. GSPL, another pipeline player, saw significant year-over-year declines in revenue, EBITDA, and PAT. They didn't get a volume boost from power and fertilizer either, similar to GAIL's issue.
And ONGC?
ONGC actually saw a quarter-over-quarter jump in EBITDA and PAT. But the report suggests this was mainly due to accounting, basically. Lower assumptions for dry well provisions. So setting aside less money for potentially unsuccessful wells.
Got it. So less about operations, more about provisioning assumptions there.
Seems that way for this specific quarter's jump, yes.
Okay, this has been a really insightful deep dive. It's clear the overall Q1 FY26 picture for oil and gas was strong, driven by that mix of refining, marketing margins, lower gas costs, and diversification for some.
Exactly. But as we saw, it's complex. Not everyone benefited equally, and there are definite challenges around volume and market share for specific players.
Understanding those individual stories and the specific drivers, it really gives you a much richer picture than just the headline numbers, doesn't it?
Absolutely. It's never a monolith. Each company is navigating its own path within this, constantly shifting energy landscape.
Indeed. And thinking about that shifting landscape with volatile global prices, changing policies, here's something maybe to think about. Given everything we've discussed, what specific factors, maybe market trends or policy moves, do you think will be the most critical for these companies' performance going forward? What should we be watching most closely in the next few quarters?